Welcome to the Deep Dive. We take that stack of sources you give us, cut through the noise, and get right to the core of what you really need to know. Today we're plunging into something, well, foundational for anyone navigating the world of finance, the psychology of money. We're not talking complex algorithms today, or those fleeting market trends. Nope, we're talking about the hidden forces inside us that shape our financial destiny. You've given us some fantastic material insights from Morgan Housel himself, summaries, explorations into behavioral finance. Really good stuff. Our mission, to pull out the most important nuggets, give you those aha moments, and basically arm you with a shortcut to understanding how your own mind is, well, the biggest factor affecting your money.
And it's such a critical mission because what's fascinating here, looking through these sources, is how often we try to separate money from ourselves. Like it's purely mathematical. But as these sources reveal, and as we'll explore, our beliefs, our experiences, our emotions, they're all deeply intertwined with every single financial decision we make. It's this field called behavioral finance, and it's really about understanding not just what we do with money, but maybe more importantly, why.
Okay, so let's unpack this central idea that Morgan Housel really hammers home. He argues financial success isn't primarily about how smart you are or your education. It's about your behavior, your actions. That feels kind of counterintuitive, doesn't it?
It really does.
Because our sources emphasize you can be incredibly bright, have advanced degrees, and still be financially illiterate, practically speaking. Or someone who might seem, well, unremarkable by standard measures could build a fortune just through consistent, sensible behaviors around money.
Exactly. He calls it a soft skill, not a hard science.
Right. And Housel explicitly says our behavior has a greater impact on financial success than technical expertise.
Which is a huge shift in perspective. And it helps explain why people, even really smart people, sometimes make financial decisions that just look irrational from the outside. Our sources really highlight this concept Housel calls "no one's crazy." It's rooted in our unique personal experiences. Think about your upbringing, the economic conditions when you were growing up, maybe generational attitudes you absorbed. Your personal experience, even if it's just a tiny slice of economic history, shapes maybe 80% of how you think the financial world operates.
So what seems crazy to me might make perfect sense to you, based on your background.
Precisely. What looks outrageous to one person is totally logical to another, given their history. Think about inflation. If you were a teenager in the 1970s, inflation feels very different. It triggers different responses than if you came of age in say, the early 2000s.
Yeah, completely different context.
So there's no single right way to handle money because everyone's starting point, their lens is just different.
Okay, this is where it gets really interesting, I think. Our sources dive deep into the specific psychological factors, the mental glitches, almost. Things that lead us astray, often without us even noticing. They talk about cognitive biases.
Yeah, these systematic patterns of deviation from pure rationality. Our brains take shortcuts. Useful sometimes, but financially risky.
So what are some of the big ones?
Well, a major one is overconfidence bias. We just tend to overestimate our knowledge or skill, our ability to predict what markets will do.
Right. Thinking we've got it all figured out.
Yeah, and that leads to things like trading too much or maybe taking on really high-risk investments because we feel certain. The sources warn, feeling like a genius in a bull market. It's probably the market, not you.
Good reminder. Always factor in luck. Okay, what else?
Another big one. Confirmation bias. We actively look for information that confirms what we already believe.
And ignore the stuff that doesn't fit.
Exactly. We filter out contradictory evidence. So financially, maybe you double down on a bad investment because you're only seeing the articles or data that support your initial decision. You miss the red flags.
That sounds dangerous. And then there's loss aversion. I think everyone feels this one. The sources really hit on how losing money hurts way more than gaining the same amount feels good.
Oh, absolutely. Psychologically, the pain of a loss is maybe twice as powerful as the pleasure of an equivalent gain. And that fear, that strong aversion to losing, it can make us way too cautious. We miss opportunities.
Or hold on to losers too long, hoping they'll come back.
Yes, hoping to just get back to even. Or maybe panic selling when the market dips, locking in those losses right before a potential recovery. It's that psychological sting driving the bus.
Okay, so we have overconfidence, confirmation bias, loss aversion. Any others that stand out?
Definitely. There's herd behavior, basically, just following the crowd. Leads to bubbles, leads to panic selling. Everyone else is doing it, so.
Safety in numbers, or so we think.
Right. And mental accounting. This is fascinating. We treat money differently depending on where it came from or what we intend to do with it.
Like a bonus feels different from salary.
Exactly. People are often way more likely to splurge with a bonus or tax refund than they would with their regular paycheck, even though, rationally, a dollar is a dollar. We put it in different mental buckets.
So our brains have these built-in biases, these shortcuts. But then on top of that, our raw emotions come into play. Fear, greed. They can just hijack everything, right? Even when we know better.
They absolutely can. They're a distinct force. The sources really emphasize how fear and anxiety trigger defensive moves, like avoiding investing altogether during downturns or cashing out right at the bottom, locking in those losses because the fear is overwhelming.
And the opposite.
Greed and euphoria, especially during market booms, this can drive really excessive risk-taking, jumping into hot stocks without doing the homework, chasing returns.
FOMO, fear of missing out.
Big time. And if you connect this to the bigger picture, these emotions often just steamroll rational thought. We end up making impulsive moves that completely contradict our long-term goals. Understanding these emotional triggers is, it's huge.
Okay, let's shift focus a bit. Beyond our internal psychology, what about the world around us? Social pressures. Our sources talk about this, especially with social media.
Oh, absolutely. The external pressures are immense. It's striking how social media, as highlighted in the sources, has essentially created this constant curated highlight reel. You see these extreme lifestyles, luxury goods, and it starts to feel almost normal, maybe even attainable in a way it didn't for past generations.
So it fuels comparison.
Massively. It creates unrealistic comparisons, this pressure to keep up, to chase what others appear to have. This can lead to a persistent feeling of inadequacy, even if you're actually doing quite well financially.
And people spend money to combat that feeling.
Right. Which leads to the man in the car paradox mentioned in the sources. You buy the fancy car, hoping for admiration, for significance. But people admire the car, they rarely notice or admire the driver.
That's a great point.
True respect, the sources argue, comes from things like humility, kindness, empathy, not the price tag of your possessions. It connects to Housel's idea that wealth is what you don't see.
Meaning?
True wealth isn't the car or the big house. It's the savings, the investments, the assets not spent, the money you haven't converted into visible stuff. Spending money to show people how much money you have is, ironically, the fastest way to end up with less money.
So the takeaway here is focusing inward, on our own values rather than trying to impress others. Easier said than done, though. Society pushes those external markers so hard.
It does, but the sources offer a counter-narrative. Housel talks about focusing on eulogy virtues over resume virtues.
Okay, explain that.
Resume virtues are things like your job title, your income, your degrees stuff for your CV. Eulogy virtues are the things people would talk about at your funeral. Were you kind, a good friend, did you make a difference? These provide real, lasting happiness. Chasing status or attention through money often backfires, making you less happy in the long run.
That reminds me of those stories about centenarians.
Exactly. When asked about regrets, they almost never say, I wish I'd earned more money. It's always, I wish I'd spent more time with family, or I wish I'd pursued that passion. It puts wealth in perspective.
Okay, so if we stop seeing money purely as a way to buy stuff or status and start seeing it as a tool, that opens things up, doesn't it? The sources keep coming back to this idea. The highest form of wealth is control over your time.
That point is central. Money's greatest intrinsic value, arguably, is its ability to give you control over your time. Freedom. The freedom to do what you want, when you want, with who you want, for as long as you want. Waking up knowing your day is yours.
That sounds like true wealth.
It really is. Savings, viewed this way, are an investment in independence. They allow you personal choice. They help you avoid that demand creep where your lifestyle inflates, and suddenly your schedule is dictated by the need to maintain it. Many high-paying jobs, paradoxically, offer very little control over your time, and that lack of autonomy is a major drag on happiness, according to the research.
And this idea of time and freedom seems linked to aligning spending with values too, right? Not just accumulating, but using money intentionally.
Precisely. Choosing to spend on experiences, especially